But let's start again with what's going on with the markets here as we continue to see this rally. I want to bring into the conversation Barry Bannister. He is Stifel Head of Institutional Equity Strategy. He's joining us from Baltimore on the phone. Barry, it's good to talk to you. So we have seen pretty consistent rally and optimism being expressed in the market. But you say in a recent note, you expect it to perhaps stall out here, that perhaps the S&P is going to stay kind of around 3,100. What do you think are going to be the limiting factors, maybe as we go into earnings season? Is that going to keep a cap on things?
Yeah. Hi, Julie. What happened is back in, I think, March 19th, we wrote a note that was very positive in the market. We were just 2.5 days from the bottom, and we felt like there was enough Fed backstop that was coming to drive equities higher. Rates were very low. PEs could expand to offset the earnings weakness. And that was a good call up to that low 3,000s mark. But at 3,100 on the 17th of June, we said the market would just calm down in the 3,100 range for much of the summer, and we'd be able to reassess in the fall. We obviously had the virus cases spiking. We had some effects on consumer sentiment. The politicization of the virus had caused some concern that mandated shutdowns in various important states would occur, and that overall, the weakness of earnings, the very high price-to-earnings ratio gave us some pause. Right now, there's just a lot of liquidity, and liquidity has been driving the market for a long time. So it's the high liquidity provided by the Fed, the very low interest rates, and some optimism on viral cures that have been driving stocks higher.
So Barry, when an investor hears that you might be neutral right now when it comes to the S&P 500, where do they go perhaps if they want to make a strategy or a strategic move? Do they need to be in cash now? You're not really going to get yield over in bonds, and they might be afraid of corporate bonds because of the economic potential for greater slowdown.
No, about a week ago, we did a very detailed study, 178 years of data on large cap equity monthly, and we're able to determine that without any doubt that the backstop and what's called fiat money, or money backed by nothing but government faith and credit, that is enough of a reason not to go to cash. You always have, with this paper money, some sort of paper backing to your paper assets. So there's no reason to go to cash. However, if you're tilting into risk, as we were from March to late March to late June, and it was very rewarding trade, we tilted back to a neutral setting on the equity weightings within the portfolios. The problem is, we are at 30% earnings growth in our estimates for 2021 over 20. The street's at 48%, which is not going to happen. Year-over-year earnings growth in 21 over 2020. So we're already trading at 27 times trailing and 22 times our forward estimate, meaning next year, 2021, and we're below the street. It's the highest ever multiple the market's ever seen in 75 years since World War II in 12 recessions. So we have, yes, a low real interest rate that is a discount rate for stocks, and it is pushing people into risk. But if you have new money coming in, Uncle Joe dies, leaves you an inheritance, I would not plow it all into stocks right now. I would average in over time. And that's because it is extraordinarily expensive right now. And your only case for going higher is bubble-like conditions, which is what we had in 1999 into early 2000, which is probably the closest comparable to what I'm seeing out there right now in terms of technology exuberance.
Barry, as we head into second quarter earnings season, I'm wondering what you're going to be looking for, listening for these reports and in the earnings calls, especially since already with PepsiCo, we had that company not giving guidance yet again for the rest of the year, and with just visibility and likely to be limited again in this earnings season.
Yeah, this market has been led by what's been colloquially called fan mag, and there are a lot of fans of that magazine. And it's Facebook, Amazon, Netflix, Microsoft, Apple, and Google. Those stocks have come to dominate the market. In fact, I believe the top half dozen is something like nearly 30% of market cap now. Their earnings are obviously going to be strong. and their PE multiples, because of their asset light, low capital intensity business models, their price to earnings ratios and return on capital are high. Yes, no question, they're world beating companies. And that's why the US stock market is the world beating index. The only issue is, though, I want to see what the other 490 stocks do in the S&P. Okay, I want to see if we're going to have capital spending. I want to see if there's an inventory pileup, any concern among bankers about lending and future loan losses that would be a credit constriction in the economy. We can't just make it on FanMag. We need a real economy and a real market that's broad and deep. So I'll be watching earnings outside of that, particularly on what's called cyclicals or capital-intensive industries. That would be financials, industrials, energy, basic materials, and even some of the capital spending side of technology.
Finally, Barry, I wanted to ask you about the sort of disconnect between all of these people out of work, right? A lot of small businesses struggling or shutting down, and then the seeming, even if we see earnings decline a lot, these large companies seem to be holding up okay. Why is consumer spending holding up as well as it has? Not that it's great, but still, what's sort of missing here? When are we going to have to pay the piper?
Well, we had 2 months of people sitting in their basement watching Netflix. And so what we had was an enormous surge in the savings rate to just unprecedented levels where people built up cash balances. I mean, think about our own lives. You didn't go to the ATM as much. You didn't pull out much cash. You didn't spend much money. So now you're sitting on a wad of money. And there's some of that. The other is they paid unemployed workers $600 of bonus payment through the end of July 31st. On top of state benefits that average about $400, that's $1,000 a week or $4,000 a month. It's nearly $50,000 a year. That's an enormous amount of money. It's actually more than the median worker was making in many occupations, about half of them. So with all that money, all that liquidity, and just an unusual situation of people being housebound and having a lot of savings build up, the economy's held on fairly well. I'm concerned, Julie, and your question's excellent. I'm concerned that 80% of those people think that they're going back to work, and that most of the job growth the last 10 years was in face-to-face, person-to-person, hospitality, restaurants, and those kinds of industries. What if those jobs don't come back? What if COVID is around for a while? What if we don't find a cure-all? Coronaviruses are notoriously difficult to vaccinate against. The common cold, influenza, these are tough viruses, and they're coronaviruses. So what if we don't? And this is with us for a long time. I don't mean to be Debbie Downer, but a 0.007 infection fatality rate times 330 million people is 2 million deaths spread out over maybe 10 years. If that's the case, if that's what we're facing, then we're not looking at a very sharp recovery in the economy and the consumer spending side. And a lot of those people are not going to go back to work, and we might have a double-dip recession. So we have to be realistic about this. Whenever I see something go up better than 50% in a very short amount of time, like this index did, I get a little bit nervous, and I'll hand off the last part to the bulls. But for me, it's getting a little frothy here. I need a little more information as we go through the summer, and then maybe we'll get positive again, but only towards autumn, I think. I need the summertime to recollect all this information on the economy and the future.
Yeah, Debbie Downer or reasonable skepticism, perhaps. Barry Bannister, Stifel, head of institutional equity strategy. Always good to talk to you, Barry. Thank you.
Thank you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.